really, it's going to be useful to have little pieces of silver to exchange for goods, essentially. So if one is even not thinking that, you're crazy, really, at this point, because if you look at the banking system, and we're going to be interviewing people over the next few weeks who are, and we interviewed Lynn Alden, we've introduced some really, loads of people, Alistair MacLeod, so many people, all seeing the same thing. This is not a coincidence. The banking system's broken. Anyone who's not actually now gearing up to take personal responsibility, and there's no excuse here, guys. Silver is so accessible to anybody. Gold, maybe less so to everybody, but silver is accessible to us all, no matter how small you are. And the big difference in the silver market that we're seeing versus gold, obviously, is that it's the little bit of extra volatility because it's non-NSFR compliant. So when we see SI, the silver futures contract, EFP'd, it ends up arriving in the unallocated form in the over-the-counter markets. So because it's non-NSFR compliance, they can and do refuse to sell the bullion to match these positions, or they will demand a very large premium over spot, which kind of negates the whole fixed process and makes a joke of it. But at the very least, they create delays. And I think, look, if there was a real price for gold and a real price for silver, then it would be immediately available and it would not have a premium. It would be the fixed price. So wholesalers have recently turned on the COMEX again to load out bullion from the COMEX vaults, catching market-making insiders way offside here. And as we've been assessing, while silver is joined at the hip to gold, silver not being an SFR client, and which gives this paper, it's expanded this paper to physical disconnect, which is just even more pronounced than in gold. So leveraged silver shorts are even more vulnerable into a gold price reset. And as we assessed last time, having dislocated the price far too far, the COMEX has come into the crosshairs for delivery, which it was never designed for, which will force market makers holding eligible silver. And eligible silver just happens to be in a COMEX registered vault and is eligible to be converted into a deliverable registered contract, but it is literally just sitting in a vault, not for sale. They're going to be forced to convert these otherwise undeliverable bullion holdings to the registered category. If they didn't, the COMEX would be forced into a force majeure condition. And we saw that in nickel. But with the COMEX, the COMEX cannot be allowed to default like the LME. It would simply cause the whole CME futures market to collapse. People would lose confidence. So obviously it's not going to happen. So really what we're saying is anything that's, even though you see the registered inventories being drawn down and they don't match what are supposed to be delivered, what's going to force the insiders to do, and they won't like this, is to take this eligible silver, which is in their accounts, to put it into a deliverable contract. What do you think they're going to want to do? They're going to want a better price. So essentially what we're saying is this is a part of a bullish process. They're going to have to actually allow a higher price. Now we can already see that the COMEX registered open interest is at an unprecedentedly low level. And any further loadouts, which is the bullion physically exiting vault doors, any more drawdowns are going to cause a big silver short squeeze. Structurally, also very similar, and by no coincidence, what we witnessed in 2008. And we've been tracking these insider efforts to cover, if you remember, the SLV, the ETF, the illusion of silver that we call it. Essentially this ETF has been building, that we've seen insiders building a short position. Now, there can be legitimate reasons for creating a short position, but it got excessively big. And so what they were trying to do was cover it. But they've been hampered by these EFP demands and loadouts, simultaneously sucking out registered silver, which they really needed to cover these positions, to address these vapor-thin physical supply shortages. Now, the insider run high-frequency trading algos have been targeting every ounce of silver they can from naked short specs, which, like gold, has driven the largest physical-to-paper disconnect again since 2008. We're not the only ones seeing this. Kranzler's seeing it. Other people are seeing it. But silver was at $8.50 last time we saw this condition. And then we saw a 3-year over $40 short squeeze into May 2011. What we're saying is the structure is there. So really, and when you've got the COMEX, and even then the COMEX was not being targeted like it is now. Look, footprints also confirm even more so than gold that it has been the specs who have been set up and really used, as we've talked about, it's been used as patsies into this HFT rigged, orchestrated 10-month unwind process which they have been subjected to, leaving them holding this bag but also pushing price to the point it put the COMEX machine into the crosshairs for delivery of undeliverable, usually spec-held naked short positions. So we detailed in the past how European, Asian, Indian wholesalers needing silver have turned on the COMEX to buy and take delivery of COMEX silver at a tiny, insignificant cost to fly it out to meet pent-up demand. Again, why wait when you can get it? And the just expired December option structure is still reflected that the specs are driven as offside as possible, but there's not enough naked short supply to close off these insider SLV short bets, which is really what this discounting was about. So this is why the options resistance at $22, you can see that the capping at 22 was phenomenal, why it has been so aggressive, clearly directly related to this SLV short position, and why there's been a coordinated attempt to cap silver from closing above 22 into options last week. In fact, while the SLV short covering sweet spot is still at $20, there's a problem for insiders trying to square up these SLV shorts. They have multiple times attempted to get it down to $20. There simply isn't enough spec short open interest to use as cover, and given the COMEX is in the crosshairs for physical delivery into offsetting loadouts of the New York vaults, they're pretty reluctant to dig a deeper hole. However, the January, now that's the December 27th option expiry, so that's a January contract, but it's expiring at the 27th of December. That options expiry is a wholly different structure, exposing the specs lured into betting against $26 through to $28, currently protected by insiders capping silver into the end of the December for their own purposes. It exposes these specs, as we've said before, to unlimited losses. These end-of-year shorts provide a lot of short cover for the insiders on the long side of spec shorts accrued since silver was sold short at $26 back in March, and we expect that gap close to ultimately get closed. So to sum up, given the tight COMEX inventories and strong Indian premiums, the COMEX is definitely in the crosshairs for physical delivery and loadout. So, as much as insiders want to discount silver futures to assist in squaring these large options-related underwater SLV shorts at $20, it is doubtful they can incite enough fresh spec shorts to take the offsetting load. If they did, believe me, it would be a huge opportunity and very, very short-lived.